Hello everyone, and a very warm welcome to today's webinar. Thank you all for joining us for this session on From Submission to Placement, Enabling Right Risk Underwriting with Real-Time Appetite and Delegated Authority Validation. We are seeing a significant shift in the London market today, where underwriting is becoming faster, more data-driven, and increasingly reliant on real-time validation. This makes today's discussion especially relevant for anyone looking at the underwriting transformation, automation, and better risk decisioning. Before we begin, let me quickly introduce myself. I'm Ashima Nagpal, and I'll be your moderator for today's session. I'm part of the marketing department with TxMinds, and I'll be guiding the conversation and moderating this discussion. Now, it's my pleasure to introduce my speakers for today. First, we have Rakesh Pal, VP and Head of Insurance Vertical at TxMinds. Rakesh brings extensive experience in the insurance domain with deep expertise in underwriting, risk validation, and digital transformation across the London market. We also have Rajiv Nair, AVP, UK and EU at the TxMinds. Rajiv has been closely involved in shaping market-facing strategies and brings strong perspectives on how insurers are evolving their underwriting and operational models. Together, they bring a powerful combination of domain expertise and market insight. Without further delay, I'll hand it over to Rajiv and Rakesh to take us through the discussion. Over to you, Rajiv.
Thank you, Ashima. Thank you for that. Thank you all for taking the time on a Thursday afternoon, and I hope the next 20 minutes prove useful. Let's start with the most basic fundamental of observations, but nevertheless the key in the London markets today. Namely, underwriting performance has become the primary driver of profitability. Now, looking at what's happening in the last 5 weeks in the Middle East, I think it just underpins what I just said. And this shift actually matters because investment income, which was traditionally the buffer which used to help cushion volatility, is no longer something insurers can rely on consistently. The keyword here being consistently. So the spotlight has moved, or rather moved back very, very firmly onto underwriting discipline and underwriting quality. Now, if you look at market signals and the overall environment, the picture is very clear. Combined ratios across commercial specialty lines are still fluctuating, often in the 95 to 105% plus range. And that's a really narrow margin for error. Okay.
And in multiple recent years, Rajiv, catastrophe losses have exceeded $100 billion annually, which only adds to the pressure.
I agree with you. And at the same time, I mean, if you look at it, here on one hand, you have an increase in cat losses, and pretty much at the same time, margin pressure continues to rise. And this, even in an environment where rates have been hardening. So hardening alone now is no longer enough to protect profitability. What this means, what we are seeing in practical terms, is that underwriting is now directly shaping 3 things: profit volatility, broker preferences, and capital efficiency.
And capital efficiency is becoming especially critical because every underwriting decision now has a direct balance sheet consequences. It is directly contributing there.
And that's right. So then the real question now is, take 2 syndicates. They're looking at the exact same risk. Why is there an inconsistency observed in risk profiling? Yeah, that difference is no longer just about market conditions. It's about underwriting judgment, risk visibility, and the ability to act or execute with precision in a highly dynamic, fluid environment. Again, I refer to the last 5 weeks, what's happened in the oil markets, for example. So today's focus, what Rakesh and I will walk you through in the next 15 minutes or so, is not about why underwriting matters. We all know that. But how underwriting execution must change from submission to placement in a real-time market.
Thanks, Rajiv. So let me add a couple of things, right? First of all, this complexity within the underwriting, I think Rajiv started touching upon some of those things, right? This is very structural. This is not temporary. right? One of the most important point we want to make today is the complexity the underwriters they are facing in the London market, right? This is not a short-term disruption which will come and disappear, right? It can be eliminated. It could be solved with a better workflow, or by bringing some real fancy digital tools. It's built into the way the market operates, the entire value chain operates, the operation itself, it basically gets executed. The ecosystem itself is inherently complex for London market. You have broker-led placement chains, where information moves through multiple different hops before it actually gets decisive. So you also have multi-carrier risk participation as well.
Yeah, and that means, you know what that means. Underwriters are assessing risk in isolation. Each decision will sit within his, her, their own subjective decision context.
Exactly, Rajiv. And then add delegated authority ecosystem, right? MGAs and cover holders. And the complexity increases further. On top of that, there is a cross-border exposure and accumulation risk that can build in a way that are not always immediately visible. That's kind of silently staying there, lying there, but that is contributing to the overall complexity and your overall profitable underwriting. So now what has changed recently, right, is the nature of the risk itself. Climate volatility, it is increasing along with catastrophe behavior in a non-linear fashion. Cyber risk, right? You know, every other organization, right, that that get exposed to the cyber risk and correlated exposures. And then comes your geopolitics, right? It's creating unprecedented cluster of exposure that can emerge very quickly. And you know what? Very good example is the war that's going on, right? um
Yeah,
I mean, that's something it is contributing to the multiple existing risk. At the same time, it is also bringing up more risk into your overall risk portfolio.
exactly. And just to add to that, the war which we're seeing in the Middle East, it's not just a risk of war, it's geopolitical risk, it's energy risk, it's cyber risk, and it's climate change risk, which is energy dependency, energy security. So these are not isolated events anymore, you know, they interact with each other, which makes risk even harder to assess through traditional methods.
That's exactly the point, Rajiv. Complexity is no longer just operational, like I was saying, right? It is multi-dimensional in nature. It is mathematical, interconnected, and systematic as well. And that raises, a difficult but very necessary question. Are our current underwriting models still operating suitable for this nonlinear risk environment? While the world around us has become fundamentally nonlinear, right? Be it a risk, the different new evolving risk, the way, the risks are moving, right? The accumulation that is happening. I think, we really need to think about it. And because of of that nature, and in this case, the challenges is not simply to bring more speed or productivity. The challenge is is a model relevance, whether your existing underwriting models, those are still relevant for your underwriting decision making. So another one very interesting topic for today, right? The backward looking underwriting problem. Now, no offense, it is not, we are saying that underwriting itself, it's a kind of staying at the back, or it's basically it's very backward in terms of its operation. It's not. But let's understand this problem. Let's diagnose it, right? Despite significant digital investment across the market, underwriting in many organization, it is still kind of very siloed, right? In practice, a large portion of submission triage, right, that is still manual, right, and which is kind of significant in its contribution. It is almost close to 60 to 70%. That means underwriter are putting more effort in, in sorting, assessing emails, scooping out the relevant information, do the necessary routing of the submission to the right underwriter, and so on and so forth. At the same way, that the different tools they are depend on, they are disconnected. They might be very modern new tools, but the data flow is not fully integrated. The cat models, they basically sit in one place, right? But that is not being fed by the recent and very I would say evolving exposure, right? And not always this entire the model and the workbench is connected to your policy admin system as well. To make this concrete, right, now let's talk about how it is actually impacting. To make it complete, right, let's talk through what actually happens today when a submission arrives, right? Like I said, it's manually triggered, it's often incomplete, inconsistent data. Then the appetite checks are sort of performed on some static rule, or based on some subjective experience. Cat exposures and models, that is one spill that is still kind of giving the outside in data enrichment, right? It is still helping in the scoring, right? And it is creating many hours of and days of delays. And finally, right, the portfolio impact is assessed after a directional decision has already been formed. So underwriting today is sequential, fragmented, and delayed, which is exactly why it becomes backward looking.
Yeah, and that's when these systems, when they don't talk to each other even in real time, underwriters are typically forced to manually bridge the gaps, and that too in siloed workflows.
And exactly, right. We then we layer on static appetites, right? The rules, and which may sound in principle, right? Those are great, but often, those are kind of applied inconsistently across the different teams, across the different underwriters, across the delegated authorities, across the different, the cover holders. The way kind of risk is kind of looked through, and perhaps most critically, the portfolio visibility is often lagging. See, by the time an underwriter has fully assessed an individual risk, the broader market condition of that particular risk specificity or density or accumulation or exposure positioning, right, or eventually a right pricing signal, those might have already changed. Because we have seen in this particular market, it is not things get solved in days or weeks. Sometimes it is even take months, right? And within that months, and again I'll come back to this typical Middle East war, things has been drastically changed since the war started. Your cyber, your geopolitical, your environmental, right? There might be any catastrophe event that is happening that is that needs to be considered as a part of our cat modeling. So these are the core issues. So the question is and we should ask to everyone, right? All the different entities. Are we truly underwriting the risk which is based on its true nature and the appetite? Or we are basically underwriting a snapshot of it, right? Which might came to us a couple of weeks back, or it came to us in past. Take a simple property submission receipt today, right? Within hours. And like I was saying, the catastrophe exposure might have shifted because of the weather, geopolitical nature, right? And the accumulation position might be out of date when it actually get reviewed and the entire risk portfolio is being assessed. So while the underwriting team is still validating the information in bits and pieces across the different, across the different categories, the way that the risk is going to be consumed by the different entities, by your primary, secondary, tertiary, right? The risk might have moved already. And that creates a dangerous mismatch. The underwriting decision may look rational based on the data which is kind of available at that point of time. But when you have accumulated data, right, that's a question, because data is kind of stale. And that is why I said, right, and Rajiv also highlighted, it is not a problem which can be solved by augmenting your workflow. It cannot be just solved by some digitization, right? It's a, it's a problem with the timing. it's a problem with holistic data visibility, and it's a ultimately a decision quality problem. And if underwriting remains this kind of backward looking, even a strong underwriting team, right, it would make a weaker decision. And that's a flaw of the entire operation itself. And not because of the judgment is of poor, my underwriting rules are poor, or might be my actuarial model, which is kind of integrated with my underwriting ecosystem, that is kind of poor. But it is just because my context has been changed and I need to rehash it in real time.
Yeah, I agree. And now coming to the crux of the matter is obviously we all heard about Rakesh talk at length about the problems, the inherent problems, and some of the solutions in underwriting. But let's talk about the impact, because as we all know in underwriting, small inefficiencies rarely stay small. They grow much bigger, even and not linearly. So even a 1 to 2% pricing inaccuracy, it can translate into a 3 to 5% loss ratio impact quite quickly.
And when that happens at portfolio scale, Rajiv, the financial consequences become very visible. It becomes very acute, and it quickly jumps up.
Yeah, we've seen that so many times happen in practice. And pricing, remember, is only one part of the picture. Delayed validation can allow hidden accumulation to build unnoticed.
And which means, you still may be writing business that appears acceptable at an individual bucket. But when it is quietly increasing the concentration of the risk across portfolio, your
Yeah,
individual
inconsistent. Yeah,
profitability gets impacted.
exactly. Inconsistent application of rules creating portfolio leakage, another problem.
Yeah, and because one underwriter may decline a risk, there is a subjectivity, my overall, risk portfolio, analysis, it is sort of still fragmented. And, one accept a similar one with a, lesser risk severity than another one.
Absolutely. And Rakesh, we have seen it in so many of our clients. Slow response times, lost broker opportunities, lost money.
Yeah, absolutely. And in London markets, especially, right, responsiveness influences not just a win rate, but the broker confidence, a mature flow, and a trustable client base.
Yeah, the London market reality, as we all know, is that a single underwriting decision does not affect only one policy, right? It influences multiple things like syndicate exposure, reinsurance layers, and even if you look at it, the broader market positioning. I mean, take a scenario which we saw the other day. A risk within one of our clients uh, was within their risk appetite quite comfortably when they viewed it as a standalone risk. It was an oil and gas, it's a future risk. But when they assessed it cumulatively, that is, when they weighed it against the geopolitical risk, they realized it was pushing the portfolio beyond a concentration threshold. Yeah. If they hadn't done it, that small gap between a standalone risk, these two standalone risks, would have resulted in a large loss over the past 5 weeks. Now, the key point here is that the system validates risk elements independently. Pricing will be here, exposure will sit there, authority sits in a third place, instead of validating them together holistically, and that too in real time. So by the time concentration risk becomes visible, the underwriting decision has already moved downstream towards placement. And that is where the hidden exposure tends to sit, not in the obvious, exceptional, out of boundary cases, but in the risks that appear fine in isolation on their own. So I think the key question in talking to underwriting leaders, or for every underwriting leader that I talk to, is this: do you know where your hidden accumulation risks are sitting today? Because by the time they become visible in a traditional reporting stroke operational cycle, they may already be financially material and not in a positive sense.
Very well said, Rajiv. I think, yeah, you covered it across all the dimensions. So, let us close today's discussion, saying that how we can solve the problem. I mean, obviously, this is not a forum to solve the entire problem, but let's be cognizant about what are the various things that we should consider, right? So uh, we really see across leading insurers, there is a shift from episodic underwriting decision to a continuous underwriting. Now, what does it mean, right? See, in practical terms, right, this changes the underwriting in three very distinctive and tangible ways. One is the decision move from periodic review to the continuous validation and more real-time validation, right? Be it any data, external data, internal signals, your CAT models, your risk exposure, your internal audits, anything and everything. Then obviously from individual risk assessment to the portfolio aware decisioning. I mean, in London market, here obviously, the risks are going to be subscribed. There are multiple parties who are going to write the risk, but then it needs to be assessed at a portfolio level and not individually only for that particular segment or that particular layer of the risk. And obviously, last but not the least, it's a static appetite interpretation to very dynamic and rule-driven enforcement. Um, Great, if AI is into the plan, I think it is a time we should do adoption as part of that particular value chain with necessary human override, right? So I think these are the typical pillar which can solve the problem. And it means it's a connected risk data. Insurers are moving towards more unified real-time view that brings all the system together. The data flow is very seamless. The market signals, external integrations are all real-time, and that is contributing to an integrating operating system and not just an integrating digital system.
And when you say market data, you are obviously talking only about internal portfolio metrics, or you mean broader external signals as well?
No, Rajiv, I think it contains both. It obviously broader external signals as well, right? Because underwriting decisions are stronger when internal risk views are combined with live external context, which are continuously evolving, right? Second is it means AI augmented decision, not automated underwriting in narrow sense, which is not we don't even see think that is immediately possible without human in the loop, right? Because of various type of errors that can that can bubble up. But the decision support that can detect the patterns across portfolios, the risk type, risk accumulation, identify signals, right? Which sits beyond human visibility and support more dynamic but personalized pricing at a lower cost of costly underwriting operations.
So if I understand you correctly, you're saying this is all about surfacing insight faster, not just removing the underwriter from the process.
Exactly, Rajiv. You are correct. It is about augmenting and recording judgment levers and not replacing it. And third, it means real-time validation. Instead of doing things in silos and relying on your past data, it should be instant appetite checking, delegated authority validation, and the portfolio impact simulation before a decision get finalized across 9 years.
Okay, so what you're saying is, in your experience or from what you have said, the benefit is not just faster underwriting. Of course, that is one benefit, but also much better control or tighter control, regulated control over portfolio consequences for profitable underwriting. Am I correct?
That's correct, Rajiv. That's correct. And precisely that's what I wanted to conclude, right? And that brings us to the key messages of this discussion today. This is not about automation of underwriting. It is about augmentation of underwriting, judgment with AI within an integrated operating model with a seamless and real-time data flow within your digital system IT ecosystem in a market defined by volatility, complexity, and speed. See, the winners are not simply be the insurers who now process things faster. There will be ones who can combine human judgment with connected data, real-time validation, and intelligent decision support. And that is where success lies right now. And that is what the continuous underwriting really represents. That's pretty much what we wanted to cover. Ashima, over to you. Thanks for hosting this
Thank
webinar
you.
today.
Thank you, Rajiv and Rakesh, for your valuable insights. Though we are running a little late, but I'm sure we are open for question and answers from the audience, right? So, audience, please pour in your questions in the Q&A segment, if you have any. Also, Rajiv and Rakesh, meanwhile, the audience is writing their questions. So while the promotions and registrations of this webinar, so I came across few questions from the audience. So let's just address those questions, right? So the first question is, so the first question is, a lot of automation initiatives end up oversimplifying underwriting. How do you avoid losing nuance and the judgment?
Rakesh?
Okay, sure. I'm gonna take it up. Yeah, great question. I think this is this is probably the most important and important concern that we hear, and very rightly so. See, the intent here is not to automate, right? Automate underwriting decision completely, like we have already highlighted, but to automate what underwriters should not have to do manually. Rules, appetite, limits, right? Delegated authorities, the appetite, the your I mean, what you are eligible to underwrite, accumulation checks. These are guardrails, and they should be enforced consistently every time in the background. See, the judgment comes after those guardrails are applied, right? Not instead of them. So automations shift effort away from validation and checking and back towards judgment and negotiation and pricing insight, obviously. In that sense, I would say automation should actually protect underwriting nuance and not removing the underwriters completely, not at all.
That's great. That's great. So another one I received, Rakesh and Rajiv, is London placements are messy and broker driven. How realistic is true real-time validation in that environment?
Okay, let me take that because I'm from a technical perspective. Let me try and answer that from a practical perspective. I talked to a lot of business leaders in this market, and the question is spot on. London market workflows are not clean or linear, even though we'd like to pretend otherwise. And that is one of the biggest reasons for failed implementations, that people pretend workflows are clean and linear. So real-time validation, the definition here should be understood very clearly. It does not mean perfection of full STP, straight through processing. What real-time in this context means is progressive validation, meaning validate what you can immediately, flag what needs human judgment or 4 eyes or whatever you want to call it, and have a mechanism for routing exceptions transparently, rather than later on in the cycle discovering them. Okay, so in that context, when you frame it like that, even partial real-time validation, especially around appetite and DA, delegated authority, can materially reduce leakage and hidden accumulation. The key word here is materially reduce, not completely reduce. Okay, so the goal should be, don't force London markets into a retail insurance model. Okay, the goal should be to bring just enough structure to protect underwriting quality without breaking these unique market dynamics.
Well said, Rajiv. With that, I'd like to conclude the webinar, and I would like to thank everyone for joining us today. Rakesh and Rajiv, thank you for sharing your insights. We hope you found this session valuable, audience, and have a great day ahead. Thanks, Harry. Thanks.
Thank you.
You too.
Thanks, Ashima. Thanks, Rajiv. Thanks, everyone.
Thank you.
Okay.
Take care.